Hello and welcome to Trading 5 Talents. In today's video, I want to go over 7 steps that I use to make the wheel a little bit easier for me to trade. Now, I work a full-time job, so I'm not in front of my computer all day. I'm not a professional trader. I'm not a full-time trader. I just do this on the side. It's sort of a side hustle for me, and so I try to make it as easy as possible while still maintaining the profit that I need to hopefully one day make it into a full-time job. So here are these 7 steps. But if you do not know what the wheel is, it's an options trading strategy that generates consistent income by selling options rather than buying them. And so usually you start with a cash secured put and you sell a put option. If that put option expires worthless, you can repeat the process and sell another put option on a stock that you like. If it expires in the money, that is, the stock price closes below the put strike price, then you're going to be assigned this particular option, and now you have to buy 100 shares for every put option that you sold against it. But now you have 100 shares of this stock, so you can now sell a covered call against this stock using your shares as collateral. Now, if the stock price closes below the call strike price, then this call option expires out of the money and you keep your premium, and you can repeat that process as well. But if the stock closes above your call strike price, this is going to be assigned to you. So now you're going to be forced to sell your shares at that agreed upon strike price. But you still keep the premium. You keep the premium when you sell a put, you keep the premium when you sell a call. So in both cases, you can generate income, and now you're back in cash. So now you can sell another put on a different stock if you want to. So you can see just from this diagram why it's called the wheel strategy. You're selling puts, you're selling calls, and you're keeping the premium regardless of the outcome. So how do I make this easier when I trade the wheel? So the first step is just finding a good stock. I mean, that's probably the most important part of running the wheel strategy, is finding a good stock. And so you have to have a stock that you're comfortable holding for a while. And I use screeners to find a stock. Now, a screener is just a tool that basically finds different stocks meeting your criteria that would be good candidates for further review on if you want to sell options on that particular stock. And so I use optionsellerroi.com, but you can also use barchart and finviz.com. And in fact, I just made a video highlighting some of the features of each of these 3 websites, and they're all free, so you don't need to pay a subscription to gain access to these screeners, but at least they give you an idea of where to start and which ticker symbols or which stocks you can do a further analysis on if you want to run the wheel on those stocks. I also trade stocks that I have previously traded. So just because I trade a stock one time doesn't mean that I'll never trade that one again. I keep it in my watch list, and if it presents a good opportunity, I'll trade it again and again and again until it no longer provides that opportunity. So I just find a stock and I keep on reusing the same ones, and I use free tools like a screener. So that's what this point is here, is just make a watch list and just keep track of the stocks that you trade, because they're probably going to be pretty good candidates for the next time around you run the wheel. Second step is knowing when to open a trade. I like to sell cash secured puts on red days. That is a day that is very negative. There's a strong decrease in the price on that particular day. I can probably even say that it doesn't necessarily have to be an overall red day. It just has to be a strong move down. So it can have a strong move down in the morning. I'll sell a cash secured put, but it starts to recover by the end of the day and ends green. Then that's not technically a red day, but because there was a strong move down, that provided a great opportunity to sell a cash secured puts. And the reason is because there's better premiums at lower strike prices. So for example, if a stock was trading at $10 and you sold a cash secured put at the $8 strike price, if that stock has a very strong red day, and let's say it goes down to $9, then you can probably get a very good premium at the $7 strike price. And now you're moving your strikes down as a stock is moving down, so you can get in at a more attractive price. So that's why I like to sell puts on red days, and in contrast, I like to sell covered calls on green days. Again, not just a green day, but a strong move upward. Again, it can move strongly at open or sometime in the morning and then end up being negative. But because there was a strong move up, that's when I want to sell my calls. And the reason? There's better premiums at higher strike prices. So this is just the opposite of what happens with puts on red days. It happens with calls on green days. You can get better premiums at higher strike prices, but also as the stock moves upward, you can get great premiums at the money. So you might even be able to get really great premiums right at your cost basis if you want to sell that close to your cost basis. But knowing when to open is really important when selling the wheel. Sell puts on red days or red moves, and sell calls on green days or green moves. Step number 3 is I just use probabilities. So I don't use technical or fundamental analysis. And that might be a little bit taboo with a lot of options traders, but I just use probabilities. One thing I would say about fundamental analysis is I have to like the stock itself. I have to like the sector. I'm not just chasing ROIs and I'm not just chasing premiums. I actually have to like the setup. So I don't really do any financial analysis and fundamental analysis of the company. I don't draw any indicators or draw any trend lines on charts. I don't use the technicals, really. But what I do like to look at are the probabilities, and that's pretty well defined with the delta values. So for cash secured puts, I'm looking for anything greater than a negative 0.3 delta, which means it has a 70 or approximately a 70% chance of expiring out of the money. That is, it has a 70% probability of profit, and that's what I'm trading based on, probabilities. For covered calls, it's basically whatever strike price I'm comfortable selling at. And in most cases, if I'm selling at or above my cost basis, I'm not looking at deltas. However, if I'm selling a covered call below my cost basis, then that's when I'm going to start looking at the deltas, and I'm looking at a 90% or better chance of profit. So that would be a delta of 0.1 or less. So again, just using probabilities. All right, step number 4, using a mobile app. So again, I'm not in front of my computer all day, so I don't have, multiple screens open and tracking different stocks and the options positions. I do everything as much as I can from my phone. So I'm just trading on the go. This is a side hustle for me. It's a part-time thing for me. So I mentioned this before, I use Robinhood for trading, and as you know, they've got a desktop platform, and they also have a mobile app that I think is a very good user interface. I like setup, it's very intuitive, so I use this for trading. It's commission free. There's a link in the description. If you sign up using that affiliate link, then we both get a free stock if you want to. But otherwise, any mobile app would work as long as they have one for your broker, whether it's Webull or Thinkorswim or Tasty Trade. But using a mobile app, for me, that works just wonderfully. I also use the Trade 5 app to track my trades. In case you're wondering what the Trade 5 app is, this is an app that I created. Basically, it's a mobile version of my trade log, so I can track all of my trades. I can see if I'm hitting my monthly goals. I can see if I'm, which trades are profitable and which trades are not after I close them. So there's a link down in the description if you want to take a look and see if that's something that might interest you. There's a 30-day free trial. I've also made a few videos on the Trade 5 app, how it works and what the layout looks like if you want to take a look at that. So both links are in the description. So again, with this step, because I'm on the go, I want to use a mobile app and I don't want to be tied to a desk when I trade. All right, the 5th step is looking for a fast order fill. So this again is just all personal preference. A lot of people may not do this, but this is what I do. I sell at the bid price and then I close at the ask price. So let's take a look on the Robinhood app. I'm looking at American Airlines right now, and we go to trade options. Let's say just for an example, I wanted to sell a put for the January 28th expiration, and I'm looking for a 70% chance of profit or greater. So let's say I look at the 17.5 put strike price, and I tap on that, and you can see right here, let's go to sell. You can see right here that I would get a $33 credit. All right. Now here under the limit price, there are two numbers. There's the bid, which is 31 cents, and then there's an ask, which is 34 cents. So the mid price, if you average 31 and 34, that would be, what, 32.5? So Robinhood rounds up to 33 credit as a limit price, and that's why that minimum credit is $33, because each contract controls 100 shares. So what I do is, because I'm selling this, I am going to be selling at the bid price, and so that is $31. So I would type in, 31 cents right here, and I would get my $31 credit. Now you can say, well, you're selling it too cheap. you should ask for more money, and that might be the case. I might be out $1 or $2, but I'm looking for fast order fills. Okay, that's how I'm making this easy for me. I don't want to wait around and tie up some money as a potential entry, and I want to be able to get into this trade quickly, and I want to be able to get out of the trade quickly as well. So that's why I sell at the bid and I buy or close my trades at the ask price. So if I was closing this trade, for example, I would go to the ask price and put in 34 cents. Now, if there is a wide bid-ask spread, then what I would do is I would go maybe a penny below or above the mid price. Now the mid price is this average price that's being shown right now. In this case, it's 33 cents. So because there's a wider bid-ask spread right here, it's more than 1 cent apart. What I might do is I might ask for, or I might sell it for 32 cents instead of 31. Now, again, most of the time my bid-ask spreads aren't too wide. But if they are, I'm going to go just below the mid price if I'm selling it, and I'm going to close my positions just above the mid price if I'm buying it back to close. So that's how I do fast order fill. That's the main reason why. It's because it's fast. It's going to open and it's going to close at those prices. Okay, step number 6 is I'm determining my profit target beforehand, or before I enter the trade. And this is pretty easy for me because I've already explained it multiple times of when I'm exiting my positions, and that is I'm exiting when most of my profit is made. And that's anywhere from 50 to 90% of the max profit. So I exit early for a few reasons. One is to avoid assignment. So if I'm selling options, or as an option seller, I should say, you run the risk of assignment if that option expires in the money. So to avoid assignment, buy back that option to close so you don't get assigned those shares if you don't want them, or you don't get your shares called away if you don't want that to happen. So that's why I would exit early. And the other reason is so that you can enter a more profitable trade. If you're holding on for that last $1 or $2 or $3, chances are there's another trade that's going to make you a lot more than $1 or $2 or $3 somewhere else. But if you're just trying to squeeze out every last drop of a trade, I just think that might be a waste of capital and a waste of time, at least in my opinion. So that's why I want to exit early and then move on to the next trade. All right, final step is I set a closing order. And this is a good to cancel order, so a GTC close order. All right, so let's go back to American Airlines in this example. So we are at the 17.5 put. Click on sell. Over here in this gear icon, and it's going to be different depending on which broker and app you use, but over here in this gear icon on Robinhood, it says customize order. You can place a stop price or a good till canceled. So that's the GTC. That's the one I would do when I'm closing an order. So I set the GTC order, and then I go in and I close my order as I would want to. And the reason that I would do this is because it reduces emotion from trading, and that's a really good rule for traders, is that you just don't want a lot of emotion in your trades. I do monitor my positions daily or several times a day in case adjustments are needed, but I'm not trying to time a specific close with a specific market move. I place those GTC orders when it's at 50% or it's at 75% or if it's at 90% max profit. I place those ahead of time, and then I can go about my day doing whatever else I need, and then you get the notification when that order is closed. So again, because I don't have, I'm not in front of my computer at all times, I want to make this process of trading the wheel as simple as possible. That's why I use these 7 steps. I find a stock with a screener. I'm knowing when I want to open a trade. I'm only using probabilities, so that really cuts down on a lot of time. I use a mobile app so I can do it wherever I want to. I sell at the bid price and I close at the ask price, so that allows my orders to fill very quickly. I have a predetermined profit target, and I place a good till cancel closing order so that I can just sort of set it and forget it. So again, these are all my opinions. You guys can trade as you like, but this is how I do it. If you're interested, and if you have any questions about it, go ahead and leave a comment down below. You can also catch me on Twitter at Trading5Talents. And if you like these videos and you want to learn more about the wheel strategy and how I use it for lifestyle trading to pay off things like a Tesla Model 3, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.